I'll also be toggling some between things I want to screen share with you. I have really two things. If you noticed, very late last night, I put up some problems I've worked, and I knew we would be doing this by Zoom. I don't particularly love my whiteboard. I have one. I could pull it up. I would feel like I would be moving that back and forth in front of the camera. And so I thought I'd go ahead and work up some sample problems myself. There are places, as you've seen in the slideshow, where the slide gets covered up by something else. There's writing over top of it or something. So I'm going to skip those and introduce my own problems and probably toggle back and forth. You'd see that on the recording, but I'll probably be toggling between the PowerPoints and the problems I worked up. And to start, this kind of thing can happen. I don't immediately see how to screen share my the rest of the the PowerPoints with you, and I just need to find them, and then we'll screen share them. I mean, trust me, they're up on my screen. It's just that I can't see how I'm going to show them to you. Oh, let's see. All right, let's see if this does it. Yeah, here we go. Okay. All right, so this is about where we left off the last time. And I think you can see this. If you have any trouble with it, let me know. But what we're doing here is we're looking at a screen that talks about how the character of the assets depending on the type of property they are, could be considered short-term, which is always ordinary income or ordinary loss, and long-term. So we have assets that have been held, if they're held more than a year under some conditions, and we're going to talk about those, they could be considered 1231 gain. And if they are, that's kind of like when we were talking in other chapters, that's preferential gain. It'll be taxed at lower rates in the end, or if it's at a loss, it'll be netted against other capital gains. Except that all the 1231s get netted first, and so you could wind up with a 1231 loss that treated as ordinary income, even though some things in there are 1231 gain, just not enough of them. So stay tuned. Couple of notes here. The gains on the sale of personal use assets are taxable capital gains, but the losses are not deductible. Remember from last class, there's a difference between personal, what's called personal property that could well be used in a corporation. It's just the type of things that people can use without removing them. Or let me rephrase, they could be removed from the building. And things that can't be removed from the building usually aren't considered personal property. But personal use is something different. That's where you're actually using it in your personal life instead of in the business. And thing to be careful with is personal use stuff is subject to capital gain. It's just you can't deduct losses. Ordinary assets are assets that are created or used in the trade or business. Business assets, if they're held for less than a year, it really doesn't matter what they are. They're basically ordinary assets. Examples are inventory, accounts receivable, machinery, equipment. If a taxpayer were to sell these at a gain, they recognize an ordinary gain, and that's taxed at ordinary rates. If they sell these at a loss, they deduct them against other ordinary income. Capital assets are held for investment, production, or personal use. And a thing to be careful with is that these capital assets depend on the purpose for which the taxpayer uses them. And in any case, it's a general truth. We're actually going to see toward the end of this today, I'm going to show you a timing problem where a taxpayer can kind of think through and get the choice of whether to show something as ordinary income or capital gain. And ordinarily, it's going to make sense, no pun intended there, but ordinarily, it's going to make sense to have capital gains when you can, because you have preferential rates there. And the other thing we'll see as we go forward is there are a lot of cases in the disposition of property where you have some type of preferential income or loss. It's not always that standard 0, 15, 20 thing. So this is one of those screens that got muddled up. And so I'm not going to really spend much time talking about this because there is one thing I'm going to point out on this slide. Most of it we talk about in more detail later. So if this slide were in better shape, I might actually talk from it. But since it's not, we're going to talk about these things in other places, with one exception. We're not going to talk, if you look next to the bottom of the screen, there's something that talks about the net gains on collectibles held for more than a year. And there's other stuff there. So I'll go ahead and mention that. It doesn't show up anywhere else. It shows up in your book, but doesn't show up anywhere else in the slideshow. Net gains held on collectibles or on collectibles held for more than a year, both that and qualified small business stock are taxed at a maximum rate of 28%. So this is like I told you, I've been telling you the whole semester. A lot of times there's not really coherent rhyme or reason to what has happened in tax. It sort of makes sense each time they do something, what they did. But when you put it all together, you can't really figure out why one point it's 28% and one point it's 25%, but it is. And so you just have to kind of do what they say. And here's an example where this is preferential, but it's 28% instead of what might be ordinary income rates higher than 28%. And ordinarily, when they do something like this, if your rate's lower than 28%, if your highest marginal rate's lower, then you're just able to take advantage of the lower rate there. But preferential, but not very preferential. And this is more of the same slide, really a 2-pager to get it all in there. And we don't talk much in here about C corporations. I will kind of remind you, because I think you'll be taking business tax next time, that many C corporations are owned by, they're considered closely held businesses and a family owns them. And, they're closely held. And when I say a family, I really mean individual taxpayers, and a few individual taxpayers own them. In our modern world, it might be brothers and sisters, husband and wife, might be friends, might even be people who don't get along, but they have similar business interests and form a company together. And the tax planning that goes into whether somebody should form a C corp or some other type of business entity is beyond the scope of this class. You're getting there. Really, the end of business tax should probably start to talk a little bit about what type of organization a taxpayer should choose. If the taxpayer is basically a person who owns a business and could have the business be totally separate from them, or included in their affairs. So we'll talk now more about 1231 assets, and later on we'll talk about depreciation recapture. That'll go on for a while. And then we'll start to talk about certain other, what I'll call kind of quick hit topics. Things like kind exchanges and involuntary conversions. But before we get there, we're going to spend a little more time on this special capital assets, whether we can consider them 1231, whether we have special depreciation considerations, and so on. So depreciable assets and land used in a trade or business held for more than a year are eligible for 1231 consideration. If the taxpayer recognizes a net 1231 gain, that gain is treated as a long-term capital gain. And so that's a preferential gain. That's a gain taxed at preferential rates. And notice it's different. We've talked about this, so this is not like first time you're hearing it, but it is reinforcing something that's pretty important in the chapter. If the taxpayer recognizes a net 1231 loss, then that loss is not treated preferentially. It's an ordinary loss. 1231 gains on individual depreciable assets might be recharacterized as ordinary income under the recapture rules. So we're going to be talking, for a fair amount of the morning about recapture rules. And this topic confused me in tax class, and I really had to get out practicing a while to sort of understand what they were trying to do here. Basically, the idea is when you were able to depreciate back when you were using this asset in your business, you got some tax deductions for that. What were the tax deductions? Were the tax deductions from ordinary income or deductions from capital income? And the view is this idea that tax should be seamless. If you got a deduction while you had an asset, you should get the same kind of capital treatment when you sell it. I'm not asking you to agree with that or not. It's just kind of how the tax, how Congress and the IRS see things. So this whole ordinary capture thing is, okay, everything would be a 1231 asset. We might say some of them are 1245 assets too, or 1250 assets too, or as well. And if we do, there might be some recapture. If there's recapture, this doesn't mean you're going to have to pay back depreciation or anything like that. What it means is your total gain might have some parts of it that are preferentially treated and some parts that aren't. And that's where several of the examples that I've come up with for you are. So this is, in a lot of ways, what I've just said, potentially recapture applies to gains, but I didn't quite say this, but that doesn't apply to losses. It's not going to change losses. It's only going to change the character of gains. So that's what the second point gets at. Also, it depends on, and that's really what they're saying in bullet 3, is whether this is going to be 1245 property or 1250 property. If it's 1245, it'll be considered personal. If it's 1250, it'll be considered real. When we get there, what you'll see in my calculations and in the way the slideshow works is that currently there's not a lot of difference between 1250 recapture and 1245 recapture. So it's almost like you still go through the exercise of considering it 1245 or 1250. Both of them have recapture potential. And actually the rates are a little bit different. So that part does remain. But sometimes there were different conditions under which you capitalized 1245 or recaptured it, I should say, and 1250. And right now, there's not a whole lot of difference in whether you recapture or not. The only difference is once you do, what the preferential rate looks like and the ordinary rate looks like. And the bottom point we've implied, but it's a big issue here when you're thinking through all of this stuff and how it's how we're recapturing things, how we're changing which parts are capital and which parts are ordinary. One thing to remember is we're never changing the amount of the gain. The gain's always going to be taxable. It's just all of a sudden parts of it might be taxed at different rates. Nothing we're going to do is make a gain non-taxable. So if you looked, and I just put it up late, so I'm not expecting you to have done that, but if you looked at the manual work that I wrote out so that I could demonstrate it, I wrote out a slide similar to this, and I'm not going to bother to show what I wrote out because this really explains it just as well. I just, when I was writing that out, I couldn't remember if this was in the slideshow or not. I knew it was in the book. So basically, this just reinforces the idea that all of these things in the right condition could be a 1231 capital gain. If we have land, the authors refer to this as pure 1231. So land by itself will never change character and be subject to depreciation recapture. That, of course, goes with the idea that we didn't depreciate the land. So when you're thinking that this stuff is based on the idea that Congress and IRS are trying to make sure that people didn't deduct depreciation at under one tax schedule, and now they're going to have a capital gain under another tax schedule. We never depreciated land, so there's not going to be any recapture there. If what we're getting ready to sell or what we've just sold is 1245 property, if it's personal property or intangibles, then the code section, of the tax code that deals with that is 1245, and you just have to follow that section. If it's depreciable real property, so now basically you've got a building or improvements in there that have been depreciated. Now that's categorized as 1250 property, and it follows the rules for 1250. And currently, although those rules still are different, they sort of turn out the same. And we'll see it in examples. Although, if the 12, at any time, Congress could change that and really come up with big different rules about capitalizing 1250. They've done that before. So the next place we go is we start to think about depreciation recapture. And we're thinking about first recapturing 1245 property. So if we have 1245 property, personal property, amortizable, intangible assets, these kinds of things, and we've just sold this, then what we're going to have to do is determine the lesser of the gain recognized or the total accumulated depreciation, which means the total depreciation we've already taken. Whichever is the lesser, that's going to be recaptured. But anything left, if we have any more gain after we recapture that, that's going to be a 1231 gain. And there's no depreciation recapture, as I've said before, on assets sold at a loss. So there are a few examples I have about this lesser of gain recognized and total accumulated depreciation. And the reason I have two is one of them, when we look at the lesser of A or B, it winds up making the whole amount of gain subject to recapture. But in the other case, the lesser makes some of it subject to recapture and some of it not subject to recapture. So I'm going to take a minute and try to screen share this with you. Um, again, once in a while, for reasons I've never figured out, I can be looking at something, try to screen share it with you, and it doesn't show up in this window of what I can screen share. And I've gotten good enough, I can kind of get that worked out, but sometimes it'll take a minute. So right now, the plan is stop sharing for just a minute, pull that one up, share that with you, keep the recorder on. If it does wind up being a drawn out process, I might stop the recording for a minute while I try to figure out how to get that screen sharing. Okay, now I can see these through my window. Let's see if you can see them, if I can get them to where I can screen share them. Yeah, there they are. Good. All right, so this is the slide that I'm not going to show you very long. This is where I wrote a slide that broke out how capital assets can also be 1231 pure, 1245, or 1250. But these next two examples are examples of what we just talked about with 1245 recapture. So I've written you this hypothetical example. By the way, what I'm showing you here now, because I'm talking about it, you can see this in the video when the video is available. I also, this is what I told you I put out late last night. I also have a 6-page set of primarily working out simple problems like this. And that's right there on Brightspace where your PowerPoint is. So you can pull this down and look at it anytime. But this is an example of 1245 recapture. ABC Corporation sold a stamping machine. So notice machines are personal property, not personal use property unless they're personally used, but they are personal property. So the facts here are that it was sold for $200,000. The original basis in the property was $400,000. Accumulated depreciation, which means depreciation we've previously taken, is $300,000. So when we come up with adjusted basis, 400,000 minus 300,000, we have 100,000 adjusted basis. So the sale price of 200,000 minus the adjusted basis of 100,000 gives us a gain of 100,000. And as we know, that gain is going to be subject to tax. There's nothing we can do to make that gain not subject to tax. The question is, what kind of tax is it going to be subject to? So the 1231 rule is that 1231 gain is recaptured over to ordinary income to the extent of the lesser of A or B. And if you're trying to match that up closely with the PowerPoint, you'll find I've reversed A and B, but they're still there. It's just what the authors list first, I call B, and what the authors list second, I call A. So the A, if you look, you have to, I guess I didn't draw that as well as I wanted to. The A is supposed to be at the 300,000. It's not supposed to be by the 400,000. I probably should have drawn a little arrow and showed you that we're trying to decide if we're going to recapture 300,000 or the gain itself be 100,000. So we recapture the lesser amount. And the thing that does is it keeps us from paying any more gain. Remember, we don't want to switch the gain amount. So because we'd taken more than 300,000 in depreciation before at ordinary rates, this gain is all going to be ordinary. But then I told you I wanted to show you an example where we look at that same rule and we find that only a part of it's recaptured. So here's that situation. I've changed some of the facts. So it says same facts, except, but really I've changed some of the facts. So the sale price is still 200,000, but if I'd left the original basis and accumulated depreciation facts the way they were, it would have come out the same. Instead, I've changed those, and the original basis now was 150,000. The accumulated depreciation was 50,000. The adjusted basis is still 100,000. So the gain is still 100,000. But now I've got A in the right place. Really, if I just drew an arrow on the last one, it would have been okay. But here I've got the A where you pretty clearly can see this is accumulated depreciation 50,000. So when the company recaptures the 50,000 of gain, that 50,000 is ordinary income, and you see that at the bottom. But the other 50,000 doesn't go away. It's just now taxed as a capital gain at preferential rates. I told you I'd be toggling back and forth. So now I'm going to stop screen sharing for a minute to go back to the slideshow. Okay, so here's where we pick back up. And this is just pointing out like the universe of possibilities. So the universe of possibilities is when a taxpayer sells or disposes of 1245 property, the taxpayer can encounter any one of these situations. They can have a gain where the only reason they have a gain is because they took depreciation deductions. They could have a gain where some of it's created through depreciation deductions and some of it's created through actual asset appreciation. Or they could have a situation where they recognize a loss. And now we'll just look through the next slide refers to some examples in the book that aren't shown, but you could go back and look at them and they'll show you how certain of these situations arose. So the facts in this, these are all examples that show up in the book. And the first one is not really an example. It just lays out the raw facts. The raw facts are an asset was sold for $610,000 and the asset has an adjusted basis of $228,658. So this asset could qualify for 1231 gain. And if it did, there's the potential. We don't know until we look at individual facts, which we do in the first, second, and third scenario. But it has the potential for up to full 381,342 recapture. The first scenario, the amount realized was 300,000. So 300,000 is more than 228,658. If you're trying to follow along with that, the 228,658 in the second blue rectangle where it says scenario 1. The blue rectangle is supposed to go from 0 to 228,658. and that's adjusted basis. The sale price at 300,000 pushes 71,342 into 1245 recapture. And so all of that gain, 71,342, is ordinary. In example 11.7, scenario 2, again, the book has these examples if you want to go back and look at them in more detail. The sale price was $620,000. So notice here, getting back to the slide before this one, there was some gain that just occurred because of property appreciation, but there's also a lot of the gain created through depreciation. So again, the first 228, 658 is basis. Here's an example that we were warned about in column 1, that all 381, 342 between 610 and 228 is ordinary income. It's all been recaptured. And on top of that, there's still a $10,000 additional gain. And that additional gain is 1231 gain, taxed at preferential rates. The last example, the property sold for 180,000, and that's less than 228, 658. So it's an ordinary loss. So now we'll talk a little bit about 1250. Sometimes the rules aren't exactly the same. They just kind of take you to the same place. So when I'll show you a 1250 example in a minute, and what you'll see is the way the recapture is calculated is the same, but the tax treatment is different. So here, if we have depreciable real property, an office building or a warehouse, if it's sold at a gain, it's not subject to 1250 depreciation recapture. Modified version of the recaptured rules can apply to C corporations, which is not something we're going to be focused on this semester. And so I'm not going to really talk about the rest of it here. I'm going to skip the scrap happy example. I like these examples. The issue is that as we talked earlier in the class, you can't see them well. So I'm going to skip this one. Skip this one. And we talked more about 1250 and unrecaptured 1250 gains for individuals. And after this, I'll show you the example I have. So we learned that depreciable real property sold at a gain is 1250 property, but it's not generally subject to recapture. But while we say it's not subject to recapture, which really means it's just not subject to a different set of rules, we're calling gain that would have been recaptured under 1245 unrecaptured 1250 gain. And so that's where I'm telling you, we're going to wind up computing the uncaptured 1250 gain the same way that we calculated recaptured 1245 gain. And then we're going to treat that unrecaptured 1250 gain at a different preferential rate. And you see that written at the bottom here. Again, why'd the IRS pick 28% for, collectibles and, qualified business stock, but here the preferential rate's 25%. Don't exactly know why they chose 25 here and 28 there. And it doesn't really matter. Instead, if we have this unrecaptured 1250 gain, that's going to be need to be determined, and we're going to tax it at a maximum, or see it taxed at a maximum of 25%. So now I'm going to screen share again. If you're getting dizzy with this, I think I really only have, I've got a couple more slides to show you. Um, and I think just to keep from the dizziness, we have a related party example I want to show you, and the related party discussion's coming close enough to this 1250 discussion that I'll probably show you that problem too. So we'll look at 1250 recapture, we'll look at related party, and then we'll get back to the slideshow here. And yes, let me correct my tongue. With 1250, it's not 1250 recapture, it's unrecaptured 1250. Okay, so falling into old terminology for me sometimes, I'm referring to this as 1250 depreciation recapture, but the way these rules have been amended, we're really figuring out what would have been subject to 1245 recapture. We're calling that unrecaptured 1250 income. And then we're treating that unrecaptured 1250 the same way we treated 1245, except there's different rates now. So in this case, actually, oh, okay, yeah. Sorry about this. This is the one. I'm gonna have to stop this and start another one next. So let me go ahead and do that. I screwed up this slide. And so I went ahead and I wrote a separate slide that's correct. And it's the next one down. So if you do later on, get into trying to look at what I've done here, it's pretty clearly referred to. I tell you when I had these six slides, okay, the 1250 one's wrong. Here's another one, and then I show you the other one. But anyway, we're here now. I'll go ahead and pull up the related party one, and we'll go through that one, and then I'll show you the 1250 recapture one. Okay, so the next place we're going is that if we get in this situation where we sell something to a related party, and the concern here is that the related party is ourself. So here in this case, Liam has this building, but he's got a corporation. And so what the IRS doesn't want is for him to somehow be able to get preferential capital gain treatment, and his business, which is him too, to somehow be able to take depreciation deductions later on. So you're going to see they stop that. And this is called, the code section that stops it is called section 1239. So Liam sold a building and land to his wholly owned corporation, Free Nation. The facts below, are the facts. What are the tax consequences? So when you see land here, it's really just to show that it doesn't have much, the issue doesn't have much to do with the land. Land is pure 1231, and Liam's not really going to be able to he wasn't able to take tax deductions himself on the depreciation for land because can't depreciate land. Free Nation's not really going to be able to benefit from that either. So even though I've got the land data on here, just to remind you, when you buy a building, you can't separate buying land. Let me touch up that statement. What I mean by that is you can't buy a building and not buy the land. That's what I mean. Now, strangely, that is 99.9% true and 0.1% false. I have never been involved in a situation, so I can't tell you how this really works, but I do know it exists. There are states, I have a feeling New York is one because of Manhattan and the way there's such a limited amount of land there. But there are states where a person can own a building and not own the land underneath. But generally, that's not true. So, for purposes of anything we do, I'm going to go ahead and just remind you there had to be land purchased in this transaction. If a building was purchased, we're just not going to be very focused on the land. So then it shows in the second bullet of facts the purchase price that Liam had paid for the building and the land, and it implies that the land has appreciated a little bit. And then Liam's accumulated depreciation on the building. So what this is showing is Liam is going to wind up recording all 100,000 as ordinary gain. Going to have a capital gain and record 100,000 as ordinary, as ordinary capital gain, not as long-term preferential gain. And this is going to happen because the IRS is concerned he already took $50,000 of deductions at ordinary rates, and he's going to provide the opportunity to Free Nation, his company, to get another $50,000 of preferential gains. I'm sorry, of ordinary loss deductions. So this related party rule blocks him from being able to get any capital gain treatment. All right, I'm going to stop screen sharing for a minute, pull up the last problem, and then we'll go from there. Wait a minute, not ready for screen share yet. Okay, so this is my corrected slide, and I've been as honest and clear as I can be about the fact that the other one's just a screw up. If you start looking at the other one, you're going to see I'm referring to B at the top, and B at the bottom isn't the same. So it was just wrong, and I've clarified it's to try to get you to ignore the top one and use this one. So here, ABC Corporation bought a warehouse for $100,000, depreciated it $50,000, and sold it for $150,000. So the gain is $100,000. If it were 1245 property, that's the way we're talking here. If it were 1245 property, the gain would have been $100,000. But then $50,000 is the accumulated depreciation. So we take the lower, that's A in this example, and this is taxed at so this is unrecaptured 1250 income, and because it's unrecaptured 1250, it's not taxed at ordinary rates. It's taxed at a 25% maximum rate. But then the other 50,000 to bring us to the whole $100,000 gain is taxed at 0, 15, or 20%. So I would look at this slide as everything here is subject to preferential tax rates, but the unrecaptured 1250 gain is a higher preferential rate. It's less preferential than the 1231 gain. Okay, the only right at the end of the course, because I'd like to get the timing problem in. It's kind of going to relate old chapter 3 stuff to what's going on here. Um, I'll get as much as I can in our discussion at about not by about 9:15, and then I'll wherever we are, however fast I go or whatever I skip, I'll come to um, this tax planning problem to make sure you consider that. All right, this is back. This is the slide that I would have talked about briefly first, but it deals with that um, sale of depreciable property to related parties. It deals with that example I showed you that was blocked by 1239. So all gain recognized from selling from selling property to a related party is ordinary income, and that's what we saw in the example. The seller's required to recognize ordinary income for depreciation the buyer will receive in the future. That's why it's showing as ordinary income. And the tax laws, this is the stuff I was telling you about earlier. They're designed to provide symmetry. And here's some examples. We're not interested in the corporate example here in an individual tax class. But the top one gets at if an individual sells something, because the individual is something we care about. The second point, there are two corporations that are members of the same group. But here, if an individual tries to sell something to his or her corporation or partnership or anything else they have an interest in, it's considered a related party transaction that's subject to Section 1239. So here's the netting process. After considering the recapture, depreciation recapture stuff, remaining 1231 gains and losses are netted. And if they're netted to a gain, that's a long-term capital gain. If they're netted to a loss, it's an ordinary loss. And it's important to mention this because now you get to something called the 1231 look back rule. I want you to think about this because when we get to the tax planning problem at the end, this look back rule would have applied. So when we see what makes the most sense for the taxpayer, they had to do some thinking about how they wanted to structure their transactions to keep from the 1231 look back rule apply. Maybe another hint I'll give you is notice that this is not a look back / forward rule. It's a look back rule. But again, the issue is only with looking back. The IRS doesn't want to see somebody separate these and get a 1231 loss in the first year that they can treat as a capital loss, and then a 1231 gain in the next year, so they can treat that as capital gain income and treat that separately. Instead, they're going to make them look back and see if they really should have done two transactions at the same time. So it's just the nature of the 1231 rule. It affects the character, but not the amount of the gains. And 1231 gains can be recharacterized as ordinary income under the look back rule. This is too busy for you to see. It generally talks through a lot of the stuff we've talked about. Um, I'd encourage you to have a look at it at your own time and ask me if you have any questions about it. This is generally what we just talked about too. I'm not going to go back and sort of read the flow chart to you, but you can take a look if this helps you see and understand the process any better. And you can certainly ask me about it if you would like to. This is something you can't see either because of the wording over it, so I'm not going to talk about it. But here are other, I told you there were other things that are sort of like quick hits in the chapter, and we get to these now. So there is another example I worked up and I didn't show you all for like-kind exchanges. I was surprised by something I read here. I've been involved in a few of these, and they're very form is very important with these. But ordinarily, here's the point. Ordinarily, they should not produce a like kind of exchange should produce no gain or loss. It should be if you're exchanging one piece of property for another piece of property that are like kind, there should be no gain or loss. One thing that disturbs that and just ruins it all is something we call boot. I'm used to boot being cash. That's usually what it is. But boot means a different kind of property. It means, for example, if one company gave up an office building and another company gave up an office building, they should be equal if they're like kind. But if one company had to throw $5,000 in on top of the building, it just blows that all. And it says, no, it really wasn't like kind after all. So quick hit, not a whole lot in the homework, wouldn't see a whole lot in the test, but quick hit with it. The transaction must meet the following three criteria. The property is exchanged solely for the like kind property. Notice here, that's a point here that you can't be throwing cash in. If the real property is not exchanged for other real property and there's cash thrown in, it's not really a like kind exchange. Both the real property given up and the real property received in the exchange are either used in the trade or business or held for investment. So for example, a business can't want to trade with somebody, find an individual that's holding property and do a like kind exchange with that. That's got to be property that's either used in the trade or business now or held for investment. And we'll see there are time restrictions. You're not really responsible for being aware of what the restrictions are. You should just know they exist. So here's the definition of like kind property. Real property. Usually it's real property for real property and very similar. Like a first general rule, this is way too general, but it's a general rule. If you're looking at somebody telling you they've done or want to do a like kind exchange and it doesn't look like the property's the same to the naked eye, that's a strike. There's a good chance it's not. So I guess I'd say if they look like they're the same kinds of property, there still might be problems. But if they don't even look like they're the same kind of property, there's pretty definitely going to be problems. So here's property ineligible for treatment. Real property held for sale. This is obviously the taxpayer's intent is going to matter here. If they were holding real property for sale, it's ineligible. You can't deal with property outside the United States. This one to me could be changed sometime, but it's not changed now. So you can't be exchanging your office building in Washington, D.C. for an office building in Tokyo. And the biggest issue to me there, the biggest reason it's not this isn't possible now is because you have two different taxing jurisdictions. We talked in the much earlier chapter about tax treaties and foreign income and stuff like that. And so it would seem possible to me that it would make a business sense to do this, and it might make sense at some future date for the rules to be changed, but nothing like that yet. And you can see they go on. The next one has another permutation of exchanging domestic property for foreign country property. So this stuff is so particular that ordinarily certain specialized law firms handle like kind exchanges. So for example, when I've done this and I've worked for a CPA firm and we have a client that says, I would like to get rid of my office building in Washington, D.C. and get one in Baltimore. What are the tax consequences of that? And then we might say, well, there might not be any tax consequences, but here's what you got to do. Here are the attorneys that specialize in this. We don't do it as a CPA firm. We do the tax for you if there is that, but the attorneys, and it has to be a special attorney that specializes in this, will understand these rules. So they'll understand what kind of property you have to give up and what kind of property you receive. Also, there's this identification period. So like this would keep an unsophisticated taxpayer from selling a property to the person in Baltimore and then not knowing for a year what property they wanted from them. Instead, there's got to be a 45-day period. Normally that specialized attorney would try to make sure those two had a good idea what they were exchanging before they ever did. And then the like kind property has to be received. So not only is it identified and planned, but it has to be received within a certain time period. And if all that happens, it's considered a like kind exchange. And if it's planned well and any of that doesn't happen, it's not. And that's why we would tell clients, engage with that attorney, pay them to do it right, and then they'll get it done and force you to do the things you need to do in the time period you need them done so that this isn't taxable. Here's a diagram of a lot of the stuff we just talked about. If you like that kind of thing, notice here the importance of the third-party intermediary. That's one thing I don't think was quite so clear in the earlier stuff. Usually the attorney or the attorney sets up an agent and they do this exchange just to make sure there's good documentation for everything in case the IRS were to question it. So this is the one I actually have a little calculation I did because I was confused by it. I told you boot throws off everything. So if it turned out that there was a property exchange in Washington for a property exchange in Baltimore and some cash was thrown in, that has the effect of just destroying a like kind exchange. And so there's going to wind up being a two-part transaction, and the boot's going to wind up with a basis. And here was the thing I actually just had to work my own little problem on. The adjusted basis of the like kind property given up, plus the adjusted basis of boot given, plus a gain recognized, minus fair market value of boot received, minus loss recognized, equals the basis of like kind property received. Wouldn't be on a test, wouldn't be anything you have to worry about, but if anyone's just confused by how this is worded, I was too, and I actually worked out a calculation to just see what they were getting at here. But then the basis of the boot received is the fair market value of the boot. So if I tell you this is usually cash, then the basis of cash is usually, what the cash is worth. It's face value. I'm at that 9:15 mark, and there's only 3 or 4 slides, so I'm just going to bolt through them. These are not big things when it comes to the final exam or anything like that, but involuntary conversions can happen when property's destroyed. And there's certain rules for that and rules for selecting qualified um, replacement property for it. Installment sales are an interesting issue. There's special tax situations there. Remember that that taxpayers are cash basis. And so in an installment sale, the person who's receiving money or the business that's receiving money isn't receiving it all at one time. When they do receive it, part of what they receive is, you know, a return of the inventory cost or something. And part of it is profit. And it's the profit part when they receive it that they are picking up income for. And there's a formula for that. And it can be kind of a preferential formula, but it's beyond the scope of what I want to talk about in the rest of the period. I just will say the related party rules show up again because this can be preferential. And if you go back to my example with Liam and the Free Nation Company, if Liam sells something to the Free Nation Company and the Free Nation Company's paying him back, then they're not going to be able to do installment reporting for that. And now for our last thing, I want to go to the tax planning problem. Okay, I think you can see this. We're at 9:18. I may go another minute or two past 9:20. We're not in the classroom. I know while we're not, some of you might have classes that are starting right after this class ends and you might have to go. That's fine. I'm just going to talk about this. Not going to run much past, but it is going to be a little bit. I don't mind you leaving if you need to. This way, I'll have a full recording of what I talked about here. The recording will be posted if you want to go back and see the last few minutes. Also, if you don't need to, this worked out problem is already in the Brightspace and you can have a look at it anytime. But what I noticed is, you can actually do kind of timing tax planning. If you remember back to chapter 3, and back in chapter 3, we talked about how a taxpayer might be able to time when they bought and sold things to take advantage of tax rules. So in this case, Liam has 2 pieces of 1231 property that he wants to sell. He wants to sell some machinery, which would produce a section 1231 loss. He also wants to sell land, which is pure section 1231 gain. His rate's 32%. His top marginal tax rate's 32%, and he's single. So he's got a couple of scenarios. One, he can sell the 1231 loss property and the 1231 gain property at the same time because he's thinking about it. He kind of wants to do it. If he does, he sells the 1231 loss property, and the loss is a deduction against the ordinary income rates. And the 1231 gain, 10,000 is a gain against the ordinary rates. They're actually netted against each other. And you can see here the tax savings is there's a $1,600 loss. With proper timing, the loss can be bigger. And this is where I said, look at the order in which these transactions are done. Liam sells land in 2021. He sells the machinery in 2022. So he's going to sell the gain stuff first. If he sold the loss stuff first, he'd be subject to the look back rules. But because he sold the gain stuff first, there's no look forward rule. So in this case, the loss I'm sorry, the land, the gain on land is sold. The land is sold, so he gets the gain in 2021, let's say, and the gain then is a gain that is at preferential rates. So he only pays 15% of tax because it's a preferential rate on the $10,000 gain. So we compute that and come up to a $15 tax hit. But by waiting until 2022, he can take a 1231 loss on the $15,000 machine. Now that's always ordinary, so he couldn't convert it to a capital loss, but he didn't have to net the capital gain against it. Instead, he could use the capital gain at the more preferential rate in the first year and then use the loss in the second year. This created a net tax savings of $3,300, and it beats the first one, but it required proper tax planning. All right, so that's where I stopped for the day. Good to see everybody this morning. Have a happy Thanksgiving. Let me know if you have any questions or anything, and we'll see each other again on November 30th. Do remember that our exam is on December 7th, which is a Tuesday, from 9 a.m. to 11 a.m. I'll keep reminding you, but the time's a little bit different. We start a little bit later. Take care.